If you know how to day trade, these are the results you can get. It doesn't matter if you have absolutely zero experience with day trading, because today, this video is going to be your very first step into day trading. Now, especially in the trading world, credibility matters. So let me briefly introduce myself. I've been trading crypto for about 7 to 8 years, and I currently trade over $4 million a day as a full-time active trader. All right, before we jump in, here's what we're covering today. What day trading is, what you need to get started, basic technical analysis, management, and mindset. 5 things, simple and clean. So, what is day trading? You've probably heard the term before, but simply put, it means entering and closing your trades within the same day. Then why do we day trade? Obviously, to make money. Nobody gets into day trading hoping to lose. So, how do we make money? You already know the basic principle. Buy low, sell high, buy back lower. There are different methods based on time. Finishing a trade in minutes is scalping. Finishing within the day is day trading. Holding for a few days to a month is a short-term swing. Holding for months is a long-term swing. And holding for years is long-term investing. Everyone has their own style, but the principle never changes. Buy cheap, sell high, or sell high and buy back cheap. And today, we're focusing on day trading. Now that we know what day trading is, we need to be prepared. You only need 4 things: TradingView, an exchange, seed money, and a trading journal. Same things should be prepared for stocks or crypto. First, TradingView. It's by far the most optimized charting platform in the world. Pretty much every professional trader I know uses it. Just Google it and sign up for free. You can upgrade later if you feel limited. They also run huge discounts during holidays or Black Friday. So subscribe monthly and grab the annual plan when it's cheap. Once you have set up TradingView, we need to choose an exchange for day trading. Stock traders use brokers. Crypto traders like me use global exchanges. I mainly use Bybit and sometimes Binance for long-term positions. You don't need to stick to just one. Use whatever fits your style like me. Bybit for day trading, Binance for long-term trading. Now let's decide on the seed money for day trading. If you're new, start small. Get used to the interface, get used to entering and exiting positions. Some people recommend paper trading with fake money, but I don't. It doesn't build real discipline because your brain knows the money isn't real. I think a reasonable amount for stocks is around 1 month of your salary. About $1,500 to $2,000 seems good for practice. For crypto, about $100 is enough, since most platforms use leverage anyway. But again, this really depends on the person. So ultimately, choose an amount where, if you lost the entire thing, it would hurt a bit, but not destroy you. In my case, I had nothing to fall back on, so I literally threw my entire monthly paycheck into crypto and practiced like my life depended on it. Honestly, that pressure is probably what helped me grow so fast. And lastly, you need a trading journal. You already know what that is, writing down how you entered and exited your trades. Almost everyone tries to keep one, but only a tiny percentage actually stick with it. Why? Because they make it way too detailed, too complicated, and eventually it becomes a chore. So, when you're just starting out, keep it simple. Simple is the key. Alright, now that we've got everything prepared, this is where things really start to get interesting. The part you were all waiting for. What we're stepping into is basically a zero-sum game, a place where you have to beat someone else to move up. That's just how financial markets work, and that's exactly why I told you to practice with a small amount before going into full-scale trading. But even if you start small, you still don't really know how to practice, right? So let me walk you through that now. We have 3 topics left: basic technical analysis, risk management, and mindset. And there's a reason they're in such order. The reason we start with technical analysis is simple. How are charts formed? As price moves, data accumulates, candles form, and those candles come together to create a chart. And within those movements, the psychology of the masses is reflected. Fear during downtrends, euphoria during uptrends. Human psychology hasn't changed since ancient times. Fear and greed are emotions every human carries, and charts visually reveal these emotions. So analyzing charts is essentially analyzing human psychology. And because human psychology hasn't changed, chart patterns repeat themselves. This repetition is called a fractal, and technical analysis is the act of identifying these fractals to anticipate the market's next move. But even if you master technical analysis, that alone won't make you consistently profitable. That's why the next step is risk management and finally mindset. These 3 are deeply connected, and you cannot skip any one of them. They're extremely important, so make sure you watch through carefully. If anything doesn't click, go back and rewatch it. Got it? But before that, there's one more thing that's even more important: hitting the like and subscribe buttons. If this video performs well, the quality of the next ones naturally goes up. 2 simple clicks for better videos later. No reason not to, right? Alright, let's get into basic technical analysis. What I'm about to show you is something I personally wish I had learned from day one. It would have made everything so much easier. And even if you already have some experience, this will help you as well, so follow along. Once you've set up TradingView, your chart will look clean like this. From here, we're only going to look for one single fractal. This fractal is called an order block. So what exactly is an order block? You all know what bullish and bearish candles are. Red candles are created during downward movement, green candles during upward movement. What we focus on is the body of the candle, the thickest part. The principle behind an order block is very simple. When the body of a candle completely engulfs the body of the previous candle. When this happens, the engulfed candle's body becomes the order block zone. Easy, right? If the previous candle was bullish and the new candle is bearish, and the bearish body completely covers the bullish body, that bullish body becomes a bearish order block zone. The opposite works the same way. So how do we use this order block zone? After an order block forms, whenever price returns to that zone, it tends to bounce. It acts like a shield. We use this principle to trade. If an order block forms during an upward move, we look to buy from that zone. If it forms during a downward move, we look to sell from that zone. Simple. But of course, the price doesn't bounce every time, so we need an invalidation level. The invalidation level is the high or low of the candle that created the order block. Sure, with other theories added, it can vary depending on the situation, but right now we're focusing on learning just one thing. So for now, set this rule. If the high or low of the order block forming candle breaks, cut the trade. Let's summarize. If a bearish candle engulfs a bullish candle, you sell from the bullish candle's body. If a bullish candle engulfs a bearish candle, you buy from the bearish candle's body. And if the order block candle's high or low is broken, you stop out. That's our rule. Now we've learned entries and stop losses. Next, we need to learn take profit. But take profit is actually the hardest part. You've probably heard the saying, buying is skill, selling is art. That's how difficult taking profit can be. But since we're beginners learning one simple system, we're going to do this mechanically. Let's use a bullish order block as an example. We said earlier that we buy from the order block zone. If that buy fills, that means price pulled back once, and before the pullback, there was a swing high. We use that swing high. If you bought the pullback correctly, once that swing high breaks, you take profit on half of your position. Then you place your stop loss at break even your entry price. A stop loss at break even means if price returns to your entry, your remaining position closes automatically. And once you do this, something incredible happens. Even if price breaks the high and then reverses, you close the trade with profit. And if it doesn't reverse, your profits grow exponentially. This concept ties directly into what we'll discuss later, risk management and mindset. It's extremely important, so make sure you understand it. If you can just master this half take profit rule, everything else becomes so much easier. The first goal of everyday trade is half take profit. The entire key to risk management and mindset is right here. I'm repeating it because it's genuinely that important. Now we've established our rules for entry, stop loss, and take profit. Enter at the order block, stop out if the order block breaks, take half profit when the swing high-low breaks, move the rest to break even after partial profit. From here, full take profit depends on your personal style. You can close everything at the half take profit point, or you can try catching a larger trend. Either is fine because once you've secured half profit, you can't lose on the trade. You now have a risk-free opportunity to experiment. Use that opportunity well. That's it for basic technical analysis. Of course, there are many other widely used tools, trend lines, channels, Bollinger Bands, moving averages, and so on. I can teach all of those, but nothing gives clearer entry, stop loss, and take profit levels than the order block. Everything else varies wildly depending on how people use it. Since there's no universal standard, master the order block first. Once you've drilled it into your system, start adding trend lines, then Bollinger Bands, then channels, one by one. This is when your own identity starts forming. You'll experience trades you're good at, trades you're bad at, market conditions you thrive in, and ones you struggle with. If you're honest with yourself and review properly, that's when you move into the more advanced phase, capital management, allocation strategies, and so on. So to summarize, master order blocks first, add other tools, and develop your own trading style. Now that we've learned how to trade using technical analysis, it's time for the heart of trading, risk management. If trading is offense, risk management is defense. Growing your capital aggressively is great, but your first priority must be protecting your capital. If you can't do that, one bad moment can wipe out everything you've built. I've seen talented traders who are much better than me get knocked out of the market because they couldn't protect their money. They disappeared completely. This isn't bragging, but the reason I'm still here is because I protected my capital. That's how important this is. So here's how to protect your capital. You just need to know 3 things: stop loss, half take profit and break even, and withdrawals. These connect directly with what we discussed earlier. When using order blocks, I told you to stop out if the order block breaks. The most important thing in trading is setting your stop loss and obeying it. If you can just follow stop losses properly, your risk management is already solid. 90% of blown-up traders ignore their stop loss and get greedy. Most of them know they should stop out. They're just blinded by greed. So the first rule of risk management is set your stop loss and follow it. Second, half-take profit and break even. As we covered earlier, when price breaks the swing high of the order block zone, you take half profit and move your stop to break even. Once you do that, even if your analysis is wrong, you still exit the trade with profit. This is a huge concept, making money even when you're wrong. Most traders know this rule. They just fail to follow it because of greed. If you consistently take half profit and move the remainder to break even, your capital will rarely take large hits. Lastly, withdrawals. Most traders have experience growing their account, but very few ever withdraw. Why? Because they fall in love with the idea of compounding. They believe in the magic of compounding, and greed keeps them from withdrawing. But if you don't withdraw, your profits are literally just digital numbers, the same as in an online game. You only truly profit when you withdraw real money. I've seen traders who withdraw half of every profitable week and others who withdraw all profits until their initial capital is recovered. The common point? They survive the longest. This market rewards those who stay alive. Even if you grow your money fast, one mistake can kill you here. To survive, you must follow these 3 rules: stop loss, half-take profit and break even, and withdrawals. Now lastly, let's talk about mindset. Psychology plays a massive role in trading. Risk management can be learned through effort, but mindset is closer to a natural talent. Still, you can train it. When I first started, my emotions were all over the place. I couldn't control myself, and I often made impulsive trades. So every time I acted emotionally, or even when the thought crossed my mind, I wrote down a new personal trading principle. Eventually, reading those principles became the first step of my daily routine. Every day before I trade, I read through all of them. I have 14 trading principles now. Originally, there were dozens, but I combined the ones with similar meanings. Most of my principles are about risk management. You can memorize technical analysis with effort, but risk management means nothing if you don't execute it. I believe risk management is the area we need to study the most. That's everything I wanted to share today. There's so much more I could say, but I try to compress and summarize it as much as possible. When it comes to technical analysis, I could literally talk for an entire month non-stop, but obviously I can't fit all of that into one video. I'll cover as much as I can in future videos, so look forward to it. That's it for today's video. Thanks for sticking around to the end. It was a long one. I wish you all successful trading.